Welcome to Cash Talk, the podcast where we delve into the depths of finance, business, and life itself. I'm your host, John Cachia, a multi-award-winning wealth advisor with a passion for empowering ambitious Australians to confidently achieve financial freedom. Hey everyone, before we get started, this is a quick reminder that everything in this podcast is of a general nature and nothing has been tailored to your personal circumstances. So please seek personal financial advice before acting on this information. Welcome back to Cash Talk, and today I'm joined by Anth. Anth, how are you, mate?
Good, thanks. How are you?
Yeah, not bad. We've got these new cards to kind of get us a little bit professional, isn't it?
Yeah, looking good, looking good.
That's it, mate. That's it. You got to be kind of living under a rock to not realise what's going on in the markets at the moment. There's volatility's back with a vengeance, and most of the stock markets across the world have been affected by some of the things that are happening in the world. If it be, the continued geopolitical issues that are happening, got to do with these the wars, but also as well too, just in regards to tensions around America and certain other countries around the world. But, just to put some numbers around some certain things, as we speak today, all odds, the Australian share index is down 10% from its peak. S&P 500, the US kind of top 500 stocks, is down about 9%. And the kind of tech-heavy NASDAQ in the US is down about 12%. And so, Anthony, first and foremost, have you been kind of fielding questions? What have you been seeing at the moment?
Yeah, look, I think so far has been pretty good for my clients. I think they're pretty trained for the volatility when these things happen, not to panic. Mm-hmm. But I'm sure there's a lot of people out there listening who are unsure, and there's a lot of uncertainty in what they do and how this affects them.
And what do you think that is, Anth? What do you think that, your clients are, you said well trained. How long does it take for you to be in that position where you're not kind of panicking, you're not having those emotions? Because when I go onto social media, I'm seeing some comments around, now's the time to buy, or, now's the time to sell, the world's coming to an end. So you've got all of this noise that's happening in the moment. Why do you think your clients are better positioned right now?
I think it is because we've got a very structured plan in play where the money that is invested, it's invested for the long term. So it's not like we're going to need this money in the next couple of years. All this money that we've been investing is for 10 plus years. So even if there is a dip in the market now, when we're 3-4 years into an investment, it's not too much of a concern because we expect that to recover in the next 6 years. So I think that's a big part of it. The amount of money, obviously we're not getting all the money out of our bank accounts and investing that all as once. We're having a look to see, okay, looking at our buckets, what do we need now, what do we need in the next few years, and what do we need in the long term, and making sure we're allocating those funds correctly so we know where we take the money from when we need those.
So do you think they have an understanding of clarity over where they're headed, but also that there's money in the market, but that's going to react that way?
Yeah, I think look, the discussions that we have of how market reacts to certain things, but as well just them knowing that this is the plan and how the market works. Yes, it's not all going to be sunshine and roses. It's going to be times where it gets a little bit scary, but because we know that's not our entire savings going to the stock market, I think that makes them a bit more comfortable because we don't really need that money for the short term.
And what's very interesting is around when I kind of founded Thriving Wealth, I wanted to make sure that we're very engaged with our clients. And so over years and years and years of educating, their ability to kind of tolerate volatility has become better. And we find that obviously when clients first start, it's around educating them on that volatility. And as time goes by, there's going to be more events where volatility kind of happens. And I still remember coming in as a fresh person out of in finance, and it took me a while to even handle it. And I know, Anthony, when you first started was like that, but the more the ups and downs continue to happen, the more an individual becomes more understanding of how market conditions work. Also, as well, too, Anthony raised a really, really good point. When you understand that the money that is in the stock market, for example, you don't need for 10 plus years, you're not really worrying about it, are you, Anth?
No, correct. Because if you've got money that you don't need right away, you're able to let it ride through cycles and stuff like that, give it enough time to recover so that losses aren't going to impact you. As you've probably heard, you only make a loss on investments when you sell. So if you're not selling and you're able to hold, and our clients are able to hold because we're not investing money that they're going to need, so they're able to hold that, run through the tough period, and then come out on the other side.
Now, we prepared some questions for today, and these are questions that we often hear, but also a few questions that got sent through to us for us to be able to answer for you. And I know that the frequently asked questions segments of Cash Talk have been doing quite well. So, we're here to kind of answer your questions. So if you ever want to know anything and you want to send your questions in, find me on Instagram, find me on LinkedIn, DM me. I'll get back to your question, hopefully on the podcast. But Anthony, let's get going on some of these questions.
Yeah, I think the first one to start off with is what caused this stock market volatility?
Yeah, so the main thing that's causing this volatility is around the tariff scenario. We've got a whole cohort of economists that are saying that this is disastrous for the world because we're moving from a globalized scenario to kind of a back to a nation orientated, like take care of your own backyard. Now, this obviously from this side of the camp is saying that pricing of goods is going to be substantially increased because, when you talk about manufacturing going back in America, for example, manufacturing back in America, the cost of hiring an American to do that service is far more than, say, in India or in China or whatever. So this tariff scenario is saying, hey, listen, well, businesses are it's going to be more expensive for them to operate under this arrangement. And there's a lot of valid points, like, regardless of which political kind of side you're on, economically speaking, I can understand the concern. And when markets sense concern or unexpected events, volatility sets in. And so these tariffs are the big driver of what's going on. Now, if you look at Trump's original term, we used to say that there was what we call the Trump effect. He would say something and then markets would go up. He'd say something else and markets would go down. And actually, when Trump wasn't in power, Elon Musk had kind of the same thing. So now you've got Elon Musk and you've got Trump both saying things, and markets are very, very sensitive because you've got, the guy who's the richest man in the world, and also you've got Donald Trump, who's the most powerful man in the world, kind of dictating what's going on in global markets. So it's very, very interesting what's going on. Do I think that volatility is going to be around? I do. I think that, all of Trump's term is going to be, headline after headline after headline. So I think we need to prepare for volatility. Now, is that necessarily a bad thing? Well, no, to be honest with you. Actually, volatility is sometimes a very, very good thing for long-term investors. You've just got to be able to kind of swallow that, understand that, and control your emotions. So obviously, coupled with that, there's other contributing factors. What's going on in Russia and Ukraine, what's going on in Israel and Palestine, what's going on with China, and also what's going on in Europe in relation to how the US is kind of treating both of those, Europe and China, and how that is playing out. And there's always other things, like locally speaking, the economy in Australia is showing signs that it's slowing down. And so, we talked about interest rates getting cut at last RBA meeting. Well, that's on the sign of weakening economic data. And so if we have economies weakening, you can understand why markets are a little bit concerned about the conditions, and you're essentially buying businesses and the market's saying that, hey, these businesses aren't as valuable as they say were, a few months ago or even a couple of weeks ago.
Yeah, beautiful. Another one we had here is how can I safeguard my investments during periods of economic uncertainty?
So I'd really go down to being, you are quite certain about if your money should be in the market or not. I think what you need to do is understand when you need that money once again. So one of the biggest things that we do is we have what we call a bucketing strategy. Bucketing strategy is split up into three main buckets of your money. You've got your safety bucket, which is like the money that you need for like the next 3 years. And that should be really in safe orientated investments. These are things like cash, okay, high interest saving accounts. Because we need that money in the next 3 years. We need certainty of that outcome. Okay, so we had a girl, for example, lady call up earlier this week, and she had $100,000 in savings, but she wanted to buy a house in the next 18 months. And she said, I want to grab that $100,000 and I want to invest that. Well, the reality is that she needs certainty of having that deposit for the house. So therefore, if she was investing it, say, in the stock market or whatnot, she'd potentially, if something happened in regards to a market crash, not be able to have that deposit for the house. And I said to her, well, if that happened, how would you feel if, your deposit would take you another 3 years to save? And she said, I couldn't let that happen. So the certainty of the money needs to be in that safety bucket. We then have a secondary bucket, which is called, or the second bucket, which is called the income bucket. That income bucket is around creating passive income from, let's call them medium-term risk investments, okay? So these are things like fixed income investments where you can drive that income. Now, this bucket needs to be very, very looked at quite well, because yes, we're trying to drive the income, but for most of our clients, that then causes tax consequences as well. And usually they're not high capital growth investments. They're more income generating, stable investments. And then we have the last bucket. And that bucket is money that you need maybe between 3 to 7 to 10 years away. So let's say 3 to 10 years away. And then you have that growth bucket, which is the shares and the property and stuff like that. That is in the growth bucket. But we're not intending on touching any of that money for at least 10 years. Now, why am I saying that to you? So if you're looking at your investments wholeheartedly and you see that your money's in the wrong buckets, first and foremost, you need to look at, do I need to realign that? But ultimately, it was like Anthony said before, well, what's actually the plan? So where do we want to be 5, 10, 15 years from that? And then combine that with the actual money itself in those buckets. And then the third part around that is then what do you need to learn? What new habits do you need to develop to be able to tolerate investing at this stage? Hopefully that answers the question.
Yeah, no, very good. What role does media coverage play in market volatility?
Well, heaps. If you kind of think about the media, if now it's like everywhere. It used to be, go home, turn on Channel 7 or Channel 9 or Channel 10 or whatever, and you'll see the news. And I remember, growing up, and there was this kind of finance segment. You'd watch it and it would be in between the news. Besides that, it'd be the newspaper. So it was very limited in regards to access of information in regards to what's going on in the market. Now it's literally everywhere. They're talking about on bad days, trillions of dollars, wiped off the market. Or they'll talk about, this person said this expert said this. And so on our phones, on our laptops, now that we're connected to the internet and we're so immersed in technology, media is looking for headlines. And those headlines cause emotion. And it's those emotions, when they're driving really, really high, cause you to make not the right decisions. And as we've said many times before, when emotions is driving up, logic is driving down. And we want to make our investment decisions based on logic, not based on emotion. So the media does have a really, really, really big play in regards to what happens in markets because of what it's looking to do. Get headlines, get an audience, but do that through emotional headlines.
Next one we've got here is, what should we sell or make changes to our portfolio?
It's a very interesting one because you need to kind of go back to what I said before around looking at the plan, looking at your situation. Now, the only thing I don't like about a question like that is around, are you trying to time the market? And so if you don't have a plan, Anth, around what asset allocation you need to get towards your goals, you're just guesstimating. You're just saying, hey, listen, I think that we should sell now because the bottom's going to go down. And the reality is that the data proves that missing the best 10 days is disastrous for your long-term investing goals, but also as well too, you don't know what's going to happen. And because you don't know what's going to happen, is it going to go down? Is it going to go up? You have to go back to what you can control. And so what you can control is fees, taxes, asset allocation, which I'll speak a little bit more about, and your behavior. The four main things. Now, when we go back to asset allocation and we look at those buckets, okay, how much goes in the safety bucket, how much goes in the income bucket, how much goes in the growth bucket? Yes, there's time horizons, but also an overlay of that is how much risk do I need to take to achieve my goals? And that's where the long-term plan comes in. And so I had a client call this week and he was like, listen, markets are down. What do you think we do? And I looked at his asset allocation, and his asset allocation was still in line with where I wanted it to be. And just so we know, this particular client, to achieve his outcome that we needed, which, his long-term goals, he needed to be 70% in growth assets, so things like stocks and property, and 30% in defensive assets, such as cash and fixed interest. So his safety bucket, his income bucket was made up of like that cash and fixed interest, and then the growth bucket was around that. Now, markets have come down by about 10%, but overall portfolio, cash has gone up because he had contributions intentionally filling up the safety bucket. And then we had those income generation from the dividends of those of those stocks over time be pumping up his safety bucket and his income bucket. So for the last probably 3 or 4 years, the income that we've been generating from the growth assets has been topping up those other buckets. And so we've actually been a little bit overweight in defensive assets. Now, when I say a little bit overweight, from that 70-30 split, we were about 5% variance off. Okay? So when the market came down by 10%, I'm looking at the asset allocation going, hey, listen, overall asset allocation, where have we moved? Have we moved, say, outside of a 10% variance? Because we don't want to be making knee-jerk reactions to make that move. Well, funnily enough, because markets have grown substantially, and this is the other thing we need to take down. Yes, it's come down by 10%, but if you zoom out a little bit and look at like the last 5 years, the growth has been exponential. So even though it's been a 10% drop, say, on the Aussie market and, roughly about 10% overall, he was actually still in line with that asset allocation. So my honest answer to the person was, we don't need to change. We need to stick to the plan. And he goes, John, when do we change? If they become out of line, if they're no longer 70-30, if they're now got more defensive assets than they've got growth assets in line with that, well, then we have to use those defensive assets to then top up the growth bucket or the growth aspect of the asset allocation, but also vice versa. If you think in what we were doing on the way up, we were using that income from the dividends and from the interest that we were earning to top up the defensive side of the portfolio because the markets were moving so quickly in regards to the way up. If we didn't do that and we didn't review and didn't adjust all the time, and when I say all the time for this particular client annually, we would have been way out of line and we may have been potentially taking on so much risk that we wouldn't have needed to. So he was obviously really reassured and, he goes, John, what happens if the market continues to kind of go down? And I'm like, well, the same applies. We look at the asset allocation because it's the asset allocation that's going to achieve your goals and aspirations. And if the market continues to go down, the defensive assets buy the growth assets. Funnily enough, you're buying these growth assets at a cheaper price. And so some people say, oh, John, doesn't that mean you're timing the market? No, I'm basing the whole investment philosophy on a predetermined strategy and sticking to it. And so the hardest thing is that on the way up, you need to take those profits and put them into defensive assets. And then on the way down, you need to grab those profits and put them into growth environments. And very, very easy in theory, but in practice, it's very hard for people to overcome their emotions and execute on what the exact plan has. So, yeah, do you do something now? Well, there's so many variables in your scenario, but a few tips today is what we do to ensure that our clients continue to achieve their goals and aspirations. And I want to kind of ask you a question. What do you think at the moment? Like, what's your views about what's going on? Like, should people be panicking? Should people be like, what's your thoughts?
I think if you've got a plan, you stick to the plan. Okay. Things like this, it's always going to happen. It's probably yes, it's been a bit of a good run in the market where it's been doing quite well, but there's always going to be times like this throughout the market cycle where we're going to have some tough times. So, just sticking to the plan, riding it out. If you've got a good plan in place, you haven't invested more money than what you can afford to lose or what you don't need in the short term. So just riding it out, sticking to it, not panicking. But then also not getting too carried away. I know some people are like, oh yes, the market's gone down, let's put all our money in there. You still have to be smart and cautious with how much money you put in and buy it on the lows because you never know how far it can go down. So just being responsible as well, and not sort of taking too much of a gamble where you don't need to.
Now, I know we're a big advocate of things like dollar cost averaging, and we've always talked around, especially when people are starting to invest, to not just grab a big chunk of money and just whack it in. And it really comes for times like this to capture on volatility, because markets go up, you want to kind of buy a little bit. When it goes down, you're still putting in the same amount, but you're just buying more of that underlying thing. And so, a lot of the things that we may say that's quite boring when it comes to finances, they're risk management tools to ensure that you can sleep at night and that you can ride through these times. Now, obviously, we've got clients that have large sums of money that's invested. So, that bucketing strategy really underpins the risk management of the portfolio to ensure it can weather the storms, because we've got heaps of money in defensive assets and we don't have overexposure in regards to growth assets. But, Anth, it's interesting because for me, and I'm going to be totally honest with you, a 10% drop for me, I feel like it's nothing. And I mean that, guys. And I'm not trying to say that from but because my money and my clients' money is set up in those buckets, I don't worry. And I remember one of my dad's mates saying to me when I first started in finance, he's like, "You're not going to be able to sleep." And I'm like, I get it. And he cared for me. It wasn't from a bad position, but for people that are trying to time the market, people that are trying to pick the market, one bad move and you're gone. And so as an advisor, if you play in that game, it's very dangerous. Yeah. I was on the forefront because there was a lot of, not a lot, but there were some advisors that were promoting only a couple of months ago about geared investments. So this was hot market, pretty good market. Market's going strong. And they were talking about not only going into the market, but borrowing to go into the market. And, there's some things like debt recycling and stuff like that, it's this buzzword that people want to talk about. Now, we only explore investments like that as the last resort if you're not achieving your goals. You don't go straight to the highest risk that you can to achieve your goals, because the reality is, and I'm just going to make this frank, let's say a couple of weeks ago you entered that market in as a dollar cost averaging strategy, and let's say you borrowed $100,000 off your home and then whacked it into the stock market. You still owe the 100, and your 100 that you've invested is now 90 grand. Now, that 90 might turn to 50. Now, just so people understand, yes, compound interest and compound growth is the eighth wonder of the world, as Albert Einstein says. And I say to my two kids, there's two magical things in this world. One is love and the other one is compound interest. Compound losses is something that we don't talk about. And so let's say we grab that 100,000, we gear that 100,000 is now 50. Okay. It's very, very difficult for that 50 to get back to that 100. Okay. And so whatever risk whatever return you're chasing, what's the risk? Now, in that scenario, let's say you went into a geared investment, or you went and you debt recycled into the NASDAQ. Now you're down to 50. Well, you're going to make 200%. You've got to double your investment to just get back to square one, and you're still left paying that debt. And so, Anthony, when it comes to our philosophy around building wealth, earn more money is number one. Control your expenses is number two. Then focus on risk, then leverage. And volatile times, actually, for people like me, it's like a really, really good learning curve for the public to understand that you can go down that return chasing way, that chasing shiny objects. It can obliterate you. Now, we're only talking about a 10% drop right now, so it's not a huge issue. But if this was a 50% drop, which can possibly happen, where is your finances going to be? Are they in those bucket structures that we talked about? Are they set up the way that it needs to be set up? Are you taking on too much risk? Are you taking on too much leverage? Because going down 50% to actually make that back, it's a hard game. Well, hopefully today's been really insightful. I know that it's probably been a little bit in the doldrums. But the reality is that I want everyone to know this is only normal. Yeah, and this is only a part of investing. It is actually how returns are made because volatility is in the market. So, if you want to know more, feel free to reach out. I'm going to be posting a hell of a lot more on socials as well too. But if you're loving these videos, make sure you click and subscribe. Share these to your friends, and on Spotify, make sure you subscribe on Spotify and on Apple Music and all the major music platforms as well too. So hopefully that's been insightful. Until next time, thank you. Cheers.
Cheers, guys.